So today we're going to start talking about leveraged buyouts. We're going to do that both today and tomorrow. We're going to build a leveraged buyout model, keying off the model we built in class last week. So what we're going to do, it's kind of an interesting exercise. We're going to put ourselves in the shoes of a private equity firm. We're going to assume that we all have a private equity firm. We're buying company A as part of a leveraged buyout. And so we're going to modify that financial model to reflect the new capitalization structure associated with that LBO. So we'll start building that model today. We'll get about halfway through. We should, by the end of today, get up through the point of having a pro forma balance sheet put together. And then tomorrow, we'll start modifying the rest of the financial model, all of our income statement, balance sheet, cash flow, debt schedule. And then we'll finish up tomorrow by doing a returns analysis. We'll also probably go and show you how to do to use a leveraged buyout model as a pseudo fourth valuation methodology. All right, so that's pretty much what we're going to cover both days. And then next weekend we'll get into M&A modeling, and then we'll talk about pitching and the M&A sale process and finish up on Sunday with recruiting. So that's kind of the roadmap the rest of the way. Slides are in the back table, as are the instructions for the LBO model that we're going to be building. So we'll get to those a little bit later. First, I want to talk a little bit about what LBOs are, what is contained in the model, why they're built, both for folks on the buy side, that is a private equity firm, as well as folks on the sell side, an investment banker. All right, so we'll talk about that. And then obviously we're going to build a model. We're going to go through and we're going to build a model that contains a purchase price calculation and calculation summary. We'll do a source and uses of cash, because that's really important. There'll be a lot of different things going on with the capitalization of the company. We'll be raising a lot of debt. We'll be refinancing some old debt, raising some new equity, buying out some old equity. We're going to have to pay some fees. All right, so the sources and uses of cash is going to tell us where all those pieces of cash are going to be coming from and how they're getting used. We'll analyze the capital structure of the deal. That is, how much debt will we have, how much equity. What does that look like relative to the purchased or to the target's EBITDA? That is, what is the multiple of debt to EBITDA? What is debt as a percentage of the total capitalization? We will then create a pro forma balance sheet, which we'll talk about a little later. It basically is a balance sheet immediately after the transaction is completed, giving us a snapshot of what the company will look like with the new capital structure in place. We'll then integrate that into the financial model. And then, like I said, tomorrow we're going to get into modifying our income statement, balance sheet, cash flow, debt schedule. We're going to have to change a lot of the links that we built last week in our model. We're going to have to modify our debt schedule because we'll have some different pieces of debt. We'll have some different terms associated with that debt. We're going to model for PIK interest, payment in kind interest, tomorrow. All right, so we'll see a lot of different things that we haven't seen yet. And then finally, we'll do the IRR analysis. Basically, what is the return to the sponsor, the private equity firm? What is the return to the hybrid debt lender? Another word for hybrid debt is mezzanine. So what are the returns to the mezz lender in the deal? And then we'll do some sensitivities. We'll calculate some credit ratios. And like I said, we'll probably also do an LBO valuation. Let's talk about what we built, what the model actually entails and why we build it. But before we get into that, first of all, I want to ask, what is an LBO? I want to make sure everybody knows what we're talking about. We're all on the same page. What is a leveraged buyout? Yeah, we're basically using a lot of debt to finance the purchase of a company. All right, so we're borrowing as much money as we can, putting in as little of our own money as we can get away with, to buy a company. Why would we do that? We've talked about debt having a lot of risk associated with it. The more leverage a company has, the more risk associated with that company, both to the debt holders as well as the equity holders. So why would we do this? Magnifies returns. Debt juices returns. So let's go back to my favorite example of a house. All right, it's the house that we talked about in class 2 when we introduced the concept of enterprise value. Let's assume we're buying a house. And typically when we buy a house, the way we do it, as we talked about before, we've got to go in, put down some equity, and traditional transaction is going to involve us putting down probably about 20% in equity and financing the balance in the form of a mortgage or debt. All right, so our capital structure is 80% debt, 20% equity, if we want to think of it that way. All right, well, let's assume a year from now we're able to, and we sell this house for $600,000. All right, so we're in a rising market, kind of hard to imagine what that might look like these days, but we're able to sell our house for $600,000. What's the first thing we need to do at that point? Yeah, you got to pay off the debt. All right, we can't just walk away with that. The mortgage holder has a first lien on the asset, so we've got to pay off our debt. All right, so we pay off $400,000, leaving us with $200,000. And I'm not taking into account fees or taxes or anything like that. We're keeping it really simple at this point. So we assume that $200,000 is basically left to equity, to us. $200,000 can go in our pocket, right? Well, our return, if we put down $100,000 and we get $200,000 at the end of year one, it's a 100% return, right? Pretty good. Not bad for 1 year, especially in real estate these days. Right, but let's assume now we can finance this a little bit differently. Let's assume now we go out and we really aggressively shop for debt, and we find a lender that's going to allow us to only put down $50,000, which obviously means the balance is $450,000 that gets financed in the form of a mortgage. Same scenario applies. After a year, we sell our house for $600,000. We pay off our debt, $450,000 in this case, leaving $150,000 to go back to equity. In overall dollar terms, it's less money, but remember, we put down a lot less. We only put down half of what we did in our first case. So this 50 has become 150. It's tripled in the span of 1 year, which equals a 200% rate of return. By borrowing more, we've been able to double our returns from an IRR or percentage perspective. Does that make sense? All right, so when we say leverage magnifies returns, that's what we mean. And this is basically the idea behind leverage buyouts. Private equity funds, the way they are set up and structured, if we had our own private equity fund, we were all the partners private equity fund, and we were structured such that our returns, the amount of cash we get at the end of the day, is based on this number here. We're incentivized to maximize this at all costs. All right? To the extent that we get over and above, we achieve something over and above our quote unquote hurdle rates, which we'll talk about in a moment, then after we've done that, an increasingly large percentage of the distributable cash from a deal starts coming our way in the form of what we call carried interest. Right? Leverage buyouts are not being done right now, as we probably all know. It's probably one of the toughest times in history for the buyout industry for private equity, mainly because this piece is absent. Private equity firms can't get debt. The debt markets are very unreceptive to highly levered transactions right now, so it's very challenging for private equity firms to put these structures together. Most private equity firms right now are focusing on portfolio management, trying to make sure the investments they have in their portfolio can be salvaged and that they don't lose too much, or that they can find a way to exit those investments somehow and still get some returns back to their investors. Right? But it's cyclical. Private equity, leveraged buyouts, very cyclical industry. Out of favor right now, but will come back. Right? Definitely will come back once credit starts to loosen up a little bit. Right? This structure, and one reason I use real estate as an example here, this structure, this leveraged buyout structure, very similar to what gets done in commercial real estate. Okay, so when we first started talking in class 1, one of the first things I said was there are a lot of different applications for what we teach in class beyond just banking or private equity. Commercial real estate is one. And this is where this leveraged buyout modeling especially really gets heavily used in a very similar fashion in commercial real estate deals. Anyone's worked in commercial real estate the last several years, notably 05 to 07, This is very similar to the structure that was getting done, not necessarily for a single-family house or home, more for purchases of office buildings, apartment buildings, industrial, etc. So commercial real estate deals, when times are good, are also very similar to leveraged buyouts, and those will come back as well. Let's talk about a model, what it's being used for on the buy side. So from a private equity firm's perspective, let's talk about what they put together in the form of a model. Again, the goal of an LBO is to acquire a company using as much debt as the cash flows of the company will support, putting in as little equity of our own as we have to do. And obviously we just covered this, the more debt we're able to use, the less equity, the more debt we're able to gain, all other things being equal, the higher the expected internal rate of return on the deal. And one of the key reasons that we put together an LBO model is, at the end of the day, to figure out what is that rate of return going to look like. Our decision as to whether we, the private equity firm, are going to do this deal in the first place is largely going to be based on this, again, because this ultimately will determine what percentage of the cash flows will come to us and how much cash, how much are we going to be able to take away. All right, so we build these models, again, as we talked about when we introduced the concept, we need several things. We need a purchase price assumption. We need to know what is our valuation going in to the deal, okay? We need to know how much cash do we need to raise, all right? So not just what do we need to pay the equity holders of the target company, but what do we need to pay in terms of the deal fees, banking fees, capital raising fees, legal fees, etc. Sometimes, in many cases, we'll refinance the old debt that's sitting on the target's balance sheet. And we'll talk about how we raise that cash. That is, what are our capitalization assumptions? How much debt, how much equity, where is it going to come from? What does each piece of debt look like in terms of its interest rate, whether it's current pay or PIK, that type of thing. If it's mezzanine debt, how much of a warrant or how much equity do we need to give up on the back end? We'll also show you how to model for that. And then we need some financial projections. Either a model that we build, which we did last week, so we know how to build a model if we have to, or maybe a model that the target has given to us as we've discussed the deal with them, as we've gone through the due diligence process. Just like any other model, we want to build these models with the ability to run sensitivities. That is, change some of our assumptions, some of our key assumptions in the model. Typically, what will the deal look like if we change the purchase price? What will the deal look like if we change how much debt, the mix of debt and equity as we just did here? All right, maybe even change the operating assumptions of the company, revenue growth, margins, etc. As we talked about, PE firms typically have a required rate of return that they need to hit. Otherwise, the deal doesn't make sense to them because they're deploying capital, they're spending a lot of their time managing an investment that at the end of the day isn't going to result in a high proportionate share of the cash coming to them. All right, so these return hurdles, a lot of times for private equity, 18 to 25% is pretty typical. Real estate private equity, I know this right now because I deal with real estate private equity folks all the time, typically low 20s. And a lot of time they're going to want to see cash-on-cash returns in the high single digits, low double digits. So pretty aggressive return assumptions. And as we saw here, if we take the opposite of this case, if we have to put in more equity and we can get proportionally less debt, then this return goes in the other direction. It goes down. Right? So it makes it more and more difficult to achieve those hurdle rates. We'll talk more about that a little later. But I think we all know the IRR is strongly driven by the amount of leverage. The amount of leverage, the more leverage we can get, juices our returns. And as I talked about earlier, leveraged buyouts are pretty out of favor right now because the debt markets are largely closed. If we can't get debt, this structure is not really available to us at all. Now, in the time, I wouldn't say the last several years, what I would say is really from the period, probably 2005 to 2007, leveraged buyouts were flying high. Very much in favor, tons of excess liquidity. lenders all across the board, whether banks or hedge funds, mezzanine funds. We're doing a lot of very aggressive deals, high leverage, light in the way of covenants. Right? Everybody remember what a covenant is? Basically a requirement of what the borrower must do or cannot do. Right? Those covenants were pretty loose for that period of time. A lot of deals had what we call PIK toggles. So the ability for the borrower to choose, do we pay our interest current or do we pay it in kind? That is, accrue it to the ending balance of our debt. Okay, and a lot of those things have really gone away, as has the leverage. You're not going to see any deals these days, at least right now as we sit here in 2009, 1 year after Lehman's demise. We're not going to see any 4 to 6 times EBITDA deals in the marketplace these days. All right, but again, that will come back. Back in the 80s, a lot of deals were getting done 10 or 12 times leverage with a lot of junk bonds. So these things do come and go. I think it's safe to say we'll never get back to those days. But probably in a few years, we'll start seeing 4 to 6 times leverage deals again, I would imagine. But oftentimes what will happen is it's kind of an either or situation. The bank might agree to 4 to 6 times leverage on a deal, but require at the same time that the sponsor have a minimum equity contribution as a percentage of the total deal. All right, so either the leverage or the percentage of the total capitalization might effectively limit the amount of credit that gets extended. A lot of times you'll see 20 to 25%. I know in real estate deals right now, commercial real estate deals, a lot of times it's 30, 35, 40% equity requirements to get deals done. Now, LBO models, right? We say that building an LBO for the buy side. Well, lenders are also what we consider buy side as well. They're putting capital into deals as well. Private equity firms are putting equity in. Lenders are putting their capital in the form of debt. So lenders would also be considered buy side. And obviously, if they're putting capital into the deal, they're going to be building models as well. From a lender's perspective, it's really not so much what are the returns. It's really more, can we get paid back? Right? Can the borrower maintain ideal levels of interest coverage, maybe fixed charge coverage? Okay? Are we seeing leverage go down over the holding period? So once the deal, initially at closing, it might be a five times leverage deal. As the company grows their EBITDA, maybe next year it goes down to 4, 4.5. Year after that, 3.5, and 3, or so forth. This is really more the goal of an LBO model from a lender's perspective, right? Can we get paid back? What are the right covenant levels to set? And how sensitive are those covenants to changes in capital structure, changes in the operating assumptions? How much cushion do we have at the end of the day? Now, on the sell side, when we say sell side in the broader context, the broader industry context, we're talking about investment bankers. Okay, and investment bankers will build these models as well. Maybe they're advising a private equity firm or a financial sponsor on a deal. Okay, a private equity firm that's interested in pursuing an acquisition, or maybe we're representing a client and selling the company in a leveraged buyout type of transaction. All right. And in this case, we're really going to look at